Hello accounts people, time to have a look at the difference between marginal and absorption costing. So we're going to do an exercise on BPP. I've revised it, improved it, I've added month 3, changed a few numbers. And it overlaps level 3 and level 4 because marginal and absorption are part of the costing unit at level 3, but the rules are in level 3. Most likely to be in AMA at level 4, definitely a potential question in level 4 or explaining it. But the rules, of course, are IASs, so they're in Dave. Is, of course, one of the tasks in the synoptic exam on the AQ 2016, and is very misunderstood. So what actually happened is we're going to get a different profit figure by adopting a different mechanism as our choice of accounting policy. However, of course, in the long run, we've got the same sales, the same selling price, the same costs. So in the long run, it'll be negligible difference. So marginal costing is just the cost of producing one more. Direct costs and variable costs. Absorption costing, we're going to incorporate some indirect and fixed costs into the cost of goods sold or cost of sales. Under the accounting rules, this is only production overheads. Of course, we still need to know our selling and distribution and finance costs, but of course finished goods are sat in a warehouse, we haven't sold and we haven't distributed them, so we can't attach that cost to them, but we do need to know what they are. Otherwise we could make some goods, think we're making a profit, and it costs us too much money to send to our customers, so then we make a loss. So I have calculated the opening inventory. Save time, I've also filled in quite a little bit of the table. I'll explain that as we go down. And we are making a steady 15,000 units a month, and we've got different sales figures and a slightly different price. The materials, the labour and the variable costs will be exactly the same regardless of our accounting policy, and the fixed production costs come in different to the budgeted figure, otherwise it wouldn't be an interesting question. So if we start off with 0, that's in the question, and then these figures will change when we put the closing inventory the previous month, and we make 15,000 units and we sell 11,000, we're left with 4,000 units. The second month we make 15,000 again, but we only sell 12,000. We've gone up to 7,000, and then in month 3 still making 15,000, but we sell more, so our inventory shrunk to 4,500 units. And this is where the first part of the calculations is. Budgeted cost is actually materials, labour and the variable overheads 30. So our closing inventory is 30 times 4,000 at the end of month 1. And at the end of month 2 we had 7,000. End of month 3 we had 4,500. That would be opening inventory, month 4 of course. So our cost of sales is opening inventory plus materials, plus labour plus a variable minus closing inventory. There we are, cost of sales 330,000. If we go across, you'll see the cost of goods sold, cost of sales changing accordingly as we go through the months. And our gross profit is our sales minus the cost of sales. Quite a profitable company. Somebody should be getting a good bonus. And our fixed overheads would be under marginal costing on an accrued basis. It's actually as it happens, not an absorbed basis. They're giving us a profit or loss of our gross profit I also see a difference in the ratios, the gross and net profit margin. Just call it profit or loss, so that'll do. And the percentages will change dramatically. One goes up, one goes down. So that's our marginal costing table. We've got our selling price, we've got our opening inventory and closing inventory valued at the budgeted cost. Because we made the same, I haven't got to worry anything about LIFO, FIFO or AVCO, anything. FIFO would of course be applied. And it's okay, we could still deal with that fairly easily. But absorption costing, we can now include an overhead absorption rate of £15 per unit. We got the £15 per unit because we took our budgeted £270,000 for 18,000 units, which is 15. So our closing inventory value per item has now gone up. Our finished goods are now worth £45 instead of £30. Sounds like a good way of making money. So let's have a look what the overall picture is. Again, we start off with zero, closing inventory. We've also got our fixed production costs, so that's an extra row in here. Our fixed production costs are what we actually absorbed, and we made, you can possibly see the formula up there, 15,000 units, overhead absorption rate of £15. So every month the fixed production costs absorbed into the cost of sales is £225,000, regardless of what the actual bill was, which means we were under or over absorbed, hence we've got two rows there to adjust. But our closing inventory is now 45 times 4,000 and 7,000 and 5 times 4,500. So our cost of sales will be bigger. In fact, let's have a look how much bigger. So D40, D41. It won't actually make any difference until I copy it across that I missed that off because it was 0. But I better put it in plus. So add all the costs, take off the closing inventory. £495,540,000 and £787,500. So our cost of sales has rocketed effectively, but our gross profit for the month will change with it. So if you didn't know what was happening, you could be alarmed. Because our gross profit has gone from 770,000 down to 605,000, from 960,000 down to 780,000, and from 1.4 million to 1,137,500. And we've got to do an adjustment for under absorption because we only absorbed 225,000 when the actual bill was 250,000. So we've actually got to take off as an expense £25,000 for the first 2 months. Again, 225,000 against 250, we've got under absorbed. But in month 3, the bill was only 200,000 and we absorbed the same 225,000. So we add that one in, that's the credit entry. So when we work out our profit or loss, we've actually made more. We've made £60,000 more. Now if you look at the table down, the difference between margin and absorption is £15. 15 times 4,000 is 60,000. That explains the difference between 520,000 and 580,000. And then we're making a lot more money. However, as the inventory shrunk, we made more money under marginal. When the inventory of finished goods increased, we made more money under absorption costing, which is the general rule. So it doesn't always work. It's not an automatic assumption. Under absorption costing, we're transferring more into the next financial year. In the long run, it evens itself out. So our current asset of inventory increases and our profit figure changes accordingly. If we did it as a percentage, let's just do the 1 month just to have a look. Because if you just sat there and you were sat there in AGM doing a quick set of ratios, so if we did the gross profit, I think I got that right, F23, 73%. Gross profit here, we'll just do month 3 again. 59%. If you didn't know what was happening, you could be alarmed. However, that didn't work out right. That's better, 62%. Again, I made a typo. What have I done? 50. Missed the F's. And that's actually formatted as a percentage. So I'll click that button. And that was month 3 when of course we made less money. So you see a big difference. Not so much the overall one because it's gone 62 to 60. But the biggest difference is in the gross profit margin, which unless you knew what was happening, you'd argue about it. So just make sure I've got all the notes in. I made some extra notes down here. That's how we calculated the overhead absorption rate. We're assuming that we've either identified the production overhead associated with this item, whatever they make and sell, or that absorbing by units is appropriate rather than machine hours or labour hours. And I mentioned this earlier, selling and distribution overheads can't be applied because we haven't sold it or distributed it. And then obviously things, the stores, if it's raw materials purchasing, it's an admin cost, but it's actually a production overhead, if you want it to be. Your decision. Fixed overheads become fixed production costs now above the gross profit line. That's why we saw the difference in the ratios, and we've had to adjust the schedule, table, statement for under or over absorption. And then if inventory increases, absorption costing gives a higher profit. If it decreases, marginal gives the highest profit. It would of course be unethical to change from one policy to another purely to make more or less money. However, absorption costing does in theory give a fairer, truer value of our finished goods, and that's a good reason for changing. You'd only change back to margin if it became too awkward or difficult or complicated to calculate accurately.